My top trades come with the best chart patterns, but without knowing how to identify it and understanding the psychology behind it, I wouldn't be able to pull this off, guys. I know over 40 chart patterns that is out there, and I bet you there's more than that. Therefore, today I'm only gonna go over the main chart patterns that I use in my day trading and swing trading. I don't want to disappoint you, but this video is going to be split into two because it's very long lesson. Let's not waste any time. Let's dive right in. Hey my friend, Zach here, and welcome to the world of investing. This channel is specifically made for new traders and struggling traders to help them get better at day trading and swing trading, as well as long-term investing, right to the charts. So starting with the bull flag pattern, basically what is a bull flag? It's when the actual bulls make a rally and they create the pole here. As you can see, that's a pole. And then the price action starts to consolidate where the bulls are taking profits and other bulls are trying to step in to anticipate another rally. So that is the pole. And guys, that is a bullish signal. We'll explain the psychology behind it in a bit. So that is the pole. And that is the flag. There we go. And that is a bullish sign. So the psychology behind it, it reflects traders taking profits after the initial rally. So they start taking profits and it does, and the buyer starts coming in during this consolidation. They're also, they're coming in anticipating another rally. When the price breaks out of this flag, it typically signals a resumption in that rally. So there, it's a resumption for another rally again. So that's the pole, initial rally. The price consolidates. Sometimes it makes actual flag like this, and sometimes it makes a small downtrend flag. And then the people are taking profits. They're taking profits, and other buyers are stepping in to actually anticipate for another rally. That's what a bull flag is. That is a good example. We have now the bear flag, and we have a good example here about the bear flag. Now let me show you one thing, and that's just an extra. I don't want to complicate it, but bear flag, basically when there is a rally to the downside, a high selling pressure, it goes all the way down, it makes a pole. That's the pole. It consolidates where the shorts are taking profits and the second batch of shorts are actually stepping in. So the price consolidates. By the time it breaks that flag, a high selling pressure starts stepping in. So you see that flag right here? As soon as it breaks it, it starts stepping in and the price goes down. Does it always go down? No, it does not always go down. It's an indication of a high probability of the price going down. So that is the second pattern. The bull flag is the first and the bear flag is the second. So again, the psychology behind it, it reflects traders temporarily pausing to cover their shorts. Okay, and they're taking profits. Okay, after the initial sell-off, while the new sellers are stepping in, and the new sellers are actually preparing to enter after this consolidation is broken. And you can see how they entered and it dropped all the way down. That is the second pattern. So the third pattern is the cup and handle pattern. You see it forms, it's a bullish indicator. It forms a shape of a cup like this, and then it consolidates as a handle, and then it takes off after that. So that is the actual cup, and that is the handle right here. And that handle, let me just mark it like this and this. And sometimes the handle goes like this. So that is the handle. That is the cup. The psychology behind it, it reflects a shift from selling to buying. So, and it's slow, it happens slowly. That's why it forms a shape of a cup. The cup indicates the initial selling pressure, followed by the gradual recovery of the buyers to regain confidence. And the sellers actually get exhausted here. And that's why after this consolidation, the buyers are getting ready to actually start the rally. And high probability, the price will actually go up after breaking the handle. So that is a cup and handle, but it's not a very clear example. But I'm just gonna go with it. Okay, let me just draw down the shape of the cup. So that is the shape of the cup. You see, and that is the handle. So just to make it a clearer picture of the handle, that is the handle, like this. And that is the cup. The clearer the pattern is, the more it has a higher probability to work. You see the break of this handle? That's when the price start rallying up. It's a bullish sign. So the other pattern is the inverse cup and handle. Basically, it's a bearish continuation pattern where the price forms an upside down cup and then a handle. Just to highlight it, just to show you, it's not a perfect example, but it works. So that is the cup. Okay, and that is the handle. There you go. So the psychology behind it reflects a shift from buying pressure to selling pressure. And then it consolidates and gets the sellers getting ready to actually take it for another rally to the downside. Show you the handle. This is the handle. I'm drawing it a little bit quickly. But if you see here, as soon as it broke down, the buyers took over and they dominated to continue that rally. It's not the clearest one, I admit it. There are clearer, but I just don't have any examples on top of my head right now. The next, it's called the head and shoulders pattern. It is a bearish pattern with three main peaks. So we have the shoulder, and then the head, which is higher than the shoulder, and then we have the other shoulder, and that is a bearish signal, and that is the neck over here. So basically that is the neck. Now the psychology behind it, it shows a shift from a bullish to a bearish sentiment. So basically the bullish tried to push the prices up, and then it went down, and then they made another run on it and they pushed the price even higher, and that created the head. They made a third attempt, which it did not go as far as the head, the highs here. So that's a shoulder, that's a shoulder, and that's the head. It did not, and then at that point they kind of got exhausted and they got disappointed. And when they get disappointed, the sellers get prepared to break the neck level, and then they go harsh on it. And look at this. They actually dominated. The bears dominated after it broke the neck. And people profited all the way down here. And then you see what I mean? That's a clear example of a head and shoulders pattern. And here is another example of a head and shoulder pattern. So let's try to identify it. I'm gonna grab my highlighter here. That is a shoulder. And that is the head. And that's another shoulder. Where is the neck? It's sitting right here. Guys, when the neck got broken, look at this move. It moved actually pretty much over 50% move. You see how head and shoulders is a significant pattern because it shows disappointment. And when disappointment reveals itself within one party, or the buyers or the sellers, it makes a big move after that. So here's another head and shoulders pattern. They're not the more perfect it looks, the better the pattern it is. But at the end of the day, it's the psychology behind it. So here's the shoulder, and here's the head, and here's another shoulder. All right. And where is the neck? The neck, we connect those two dots at the bottom of both sides of the head. That's basically, actually I don't want a straight line, I just want it to connect those two dots. Basically that is the neck. Okay, so again, the psychology behind it, the bulls tried to push, the bears actually take it back to approximately the same level, the bulls give a better push and a higher push, and they got exhausted here, and then it took it back. But you know what, they did not give up hope. So they gave another push, but it did not go all the way up or even higher than it was. Then the disappointment start taking place. As soon as the neck gets broken, look at this move, and it starts rallying all the way down. I hope, guys, that is clear. So the next one is actually the inverse head and shoulders. So it's the same as head and shoulders, but it's the other way around. It's upside down. And also it has 3 peaks. Okay, let me explain. Well, let me show you. We have an inverted shoulder, and then we have the head, and then we have the other shoulder. That's a smaller shoulder. We have the neck here. Okay. Actually, that's the neck. Sorry, I apologize. It's the peak of both sides of the head. That is the neck. The bears were trying to dominate the prices down. The bulls push back up. The bears actually makes another rally, and it gives them a nice hope that they broke actually that support area here. And then the bulls managed to push the price all the way back up. And then the bears wants to take another shot at it, and they pull it back down, but it did not go down enough, and they start getting disappointed. And at that point, the bears got ready for another rally. And look at this rally. You see this rally up? That's because of the psychology behind it. And guys, most of the time, and that's my highest probability and the highest pattern that actually works within all the patterns that I've showed you. It's the inverse head and shoulders and the head and shoulders. And at the end of, after I'm going through all these examples and explaining all the patterns, I'm gonna tell you which ones actually work the best and why do they work the best. And here is the other example of inverse head and shoulders, and that's a clear one. I like this one. So let's highlight the shoulder and try to guess it with me, okay, guys? So you can start identifying. That is a shoulder, inverse head, shoulder, and that's the inverse head, and it's a clean looking one. And that is the second shoulder. The neck is sitting right here like this. Okay. As soon as the neck got broken, the bears tried to hold their ground, but they couldn't. And it got consolidated, and the bulls start stepping in, and boom. You see the psychology behind it? That works most of the time, especially those ones. But at the end of the day, I'm gonna tell you, I don't care if it works or not. What I care that it makes a move, and I'm gonna explain at the end. So the next pattern is the ascending triangle pattern. It's a bullish continuation pattern. The way I'm gonna show it to you, so basically there is a horizontal resistance. You see that resistance level? 1, 2, 3, 4. Okay, and then there is an uptrend support that makes actually a triangle. You see that? That's an ascending triangle. Let me explain the psychology behind it. So the bulls creates a support area, and the bears actually creates a resistance area. When it pulls back, the bulls manage to push the price up and hold a higher low. And if you're not sure how the higher lows goes and higher and lower lows and all this, go back and watch the previous video about support and resistance. And when they hold a higher low, that means the bulls are gaining more confidence. So they push it back up, it resists at the same area. And then it pushes back up, it resists at the same area. And then the bulls makes another higher low, and until it breaks. And when it breaks, that means the bulls are gaining confidence all the way. And once it breaks, the bulls takes over and the bears actually give up. That's the psychology behind it. Does it always work? No. Here's another example about the ascending triangle. So we have, first we identify the actual horizontal resistance, and then we identify the uptrend support. The bears manage to make a resistance area and they push the price back. The bulls manage to make a support area and then they push the prices up. The bears manage to push the price back down, but the bulls makes a higher resistance area. So it's a higher low, and then they push the prices up, where the bears takes a stand at the same level, previous level that they made. And then the bears pushed all the way down, and then the bulls hold a higher low than the previous low. And then the bulls push the price all the way back up to the same level, but the bears actually take a good stand and they push the prices all the way down to have the bulls take a stand and actually make a higher low. See, higher low, higher low, higher low, higher low, until it actually gets really close. At this time, I believe what happened in news or something that came in and actually broke that resistance area. And when it breaks it, it gives you a nice move. It gave you a move from $39 all the way to $44 or $45. That's $6 move. Okay, that's about like 10%. You see how clear that is? So now we have the other pattern. It's called the descending triangle, where it's the opposite of the ascending triangle, where the support line is a horizontal support line. That's a support line. That's a horizontal support line. Clear? 1, 2, 3. That's an area. And then the resistance is actually going down. That's the resistance area. In that case, it was supposed to break down and go all the way down. But remember, as I said, it does not matter which way it goes. It creates an emotional state here. So let me just explain. The bears take and makes a resistance area here, and it pulls all the way back down. Okay, and the bulls actually makes a support area, but the bulls push it back up. The bears managed to make a lower high, so they did not allow the price action to go all the way back up to this level, and that it makes them gain confidence. The bears actually push the price down. The bulls stand their ground at the same level, and then the bulls push the price up, and the bears makes another lower high, and then the bears push the price down, and the bulls manage to actually hold that resistance same area. But all the time the bears are winning. Now at this is supposed to be a bearish pattern, but I'd like to show you that sometimes it does not work as a bearish pattern. It actually reversed the whole psychology, and once it broke that, the bears got disappointed big times. After all this work, they were expecting it to drop all the way down. Sometimes other factors plays a role, whether it's news or fundamental that actually took place at that time or something. It does not matter. What matters is a big emotional reaction happened at that time, at the break of either of those sides, either this side or this side. All right, either down here or up here. But I'd like to show you that yes, it is a bearish pattern, but it did not actually go the way the bears wanted, so it ended up going upwards. I hope I made it clear. So here's another example of a descending triangle too. So let's see the descending triangle. Okay, that's a support. That's an area of support. 1, 2, 3, 4, 5, 6. And we have the trending down resistance. It's the same psychology. So the bears managed to take a stand here and push the price all the way down. The bulls held at this area and pushed the prices all the way back up, but the bears made a resistance at a lower high. So that was the highest, and that is a lower high, and they push all the way down, and then the bulls managed to stand at the same level. The bulls pushes the prices back up, but the bears makes a lower high and that level, and that's what's making them gain confidence. And the bulls tries to take over. No, it did not work, and they made it at a lower level than this one, or at the same, it doesn't matter. And the prices keep bouncing down at this trending triangle. The bears actually were able to reject the price at this level, which is a lower than this high, than this high, than this high. And then now the bulls is standing at the same level. Let's see what's good. This is a nice, if you guys want to market and watch what's going to happen in the next few days or the next few months. You see LRCX, it's Lam Research. Okay, it's a technology sector and semiconductor equipment and materials. Now, you can watch this. You can put it on watch and actually start watching what's going to happen with this. And let's see if it breaks up. The bears are going to be very disappointed and it's going to make a rally. And if not, the bears are going to get ready. It might actually bounce and take a small resistance level here and go down. You never know. But that's a great example you can see. Now, the other pattern is the ascending wedge. So it's very close to the actual ascending triangle or something like that, but it's a wedge. So it's not, there's no horizontal support or resistance. Basically, it's an ascending one. So let's say we have this. That is a resistance, that is ascending resistance, and an ascending support that actually at one point it intersects, and that's called a wedge. All right, and also that's one of my favorite. I'll tell you at the end why is my the patterns are my favorite. Why are they my favorite? It's a bearish pattern. Let's explain the psychology behind it. The bears makes a stand and pulls the prices down. The bulls makes a support area. and the bears actually makes another stand and pulls down the price, and the bulls makes a higher high, and the bears are actually could not actually hold their initial area, so it made a higher high. The bulls actually makes another higher low. So you see that stair step, the bears are actually pushing the prices, the support upwards, and the bears are not able to hold their ground. So the bulls are breaking the bears' wall of resistance here and here and here, and it goes up and it makes a higher low. It goes up and makes a higher low, and it goes up and makes a higher low, while all the time they're breaking their walls and making it higher. So basically it looks like it's supposed to be a bullish move. Okay, why? The bulls are actually winning here, but the psychology behind it, they're gonna get to a point where the bulls are gonna get exhausted, and on top of that they're gonna get disappointed. That's why it's a bearish move. So when the bulls get exhausted and disappointed, the big move happens right after. I believe this kind of battle is a very strong battle, and it's really tiring for either sides. And sometimes you see these kind of things, and if you see a breakout, a pretty good one, it actually soars all the way up. It makes big moves. I'd like those wedges. It makes a big move after it. So that's another example of an ascending wedge, which it makes an ascending support and an ascending resistance. It's that chart is not very clear, but it's okay. I can use it as an example, and I'm pretty sure you guys are smart and know what I'm talking about. And if you have any questions, please don't hesitate to ask in the description or in the comments. So that's an ascending support, going up support, right? And that is an ascending resistance. You see that? It makes a triangle, but nothing is a horizontal one. It is a bearish, again, we said it's a bearish sign. It looks like it's bullish because it's making higher lows and higher highs. But when the bulls get exhausted, that's when the bears take a heavy step and the bulls panic sell because they get disappointed at the end of the day. And these kind of moves, I love it when it breaks and it retests that support area, or it tries to, because the bulls gets more disappointed at that point, and it makes a beautiful nice move to the downside. And I usually capitalize on these kind of moves a lot. So again, just a quick highlight: the bears makes a stand here, and that's a resistance area. The bulls makes another support area. The bulls pulls back up and they make a higher high, and then the bears pull the prices down. Bulls makes a higher low, and then a higher high, and then a higher low, and until it breaks. Once it breaks, what happened is it's supposed to be a bullish sign, but the bulls get disappointed and exhausted at the same time, and that's when the big move happens after. So here's another example. You see this one? That's an ascending support, and that's an ascending resistance. Let me fix it. There you go. 1 point. That's a clean one. Okay, so higher lows and higher highs, but at the same time they get to match each other, and then the price starts getting closer and closer and closer. That means one of them is getting exhausted, and most likely is the bulls are getting exhausted because they're putting the more effort into making the price go up. And now we have the descending wedge. It's the same concept, but it's the opposite of ascending wedge. So there's no horizontal support or resistance. It's actually a trending down support and trending down resistance, and that's a trending down resistance. You see 2, 3, 4. It tried to break, it didn't work, and that's 5. Now here is the trending down support. Okay, and at the end they meet up to be a triangle, and so the prices are getting closer and closer and closer to each other. But the psychology behind it, the bulls makes a stand, they push the prices higher, the bears makes a stand, and the bears manage to actually break the support, the previous support, right? So that they create another support below it, so it makes a lower lows, and then the bulls fail to reach all the way back up, and the bears manage to make a lower high. So the bears are actually dominating here, okay? But one of them at the end of this move, they're gonna get exhausted. And who's gonna get exhausted? Most likely the bears are gonna get exhausted because they're putting the more effort to make the price go down. Once it breaks, that's when actually the bulls will take a good step and they start rallying the price up after the break of this pattern. Usually I like the test back because it actually makes the bears more disappointed, but sometimes it does not work. It tests back and then it drops all the way down. The next pattern we're gonna go over is the symmetrical wedge pattern. So it's a wedge pattern. The support is ascending and the resistance is descending. So it's an uptrend support and a downtrend resistance, where it kind of makes it equal and even. It's not going up or down. Okay, that's an example of the support going up. Okay, and the resistance is going down, and the range starts getting tighter and tighter and tighter. That means both sides are losing momentum, and it's getting to a point that they don't know who's gonna win this battle. Whoever breaks this support line or resistance, whoever breaks it is gonna be the winner, and they're gonna the other buyers are gonna rush into that battle, or the sellers, if it breaks down, the sellers will actually start moving into that pattern. So if it goes down below this, the sellers will dominate. But in this case, what happened is the bulls dominated here, and they made a nice move. That's a 30% move pretty much of the whole stock. That's a huge move. If you catch a part of it, you made good money. So that is another example of an symmetrical wedge pattern. As we said, make it a uptrend support, and the bears managed to make it a downtrend resistance, and that's what makes it another symmetrical. Now when it breaks, guys, look how big of a break is that. That's pretty much a 30% of the move. The bulls, for some reason, for some news, for I don't know what it was, they managed to actually push it back up. It doesn't really matter. What matters is if we can capture this move. Guys, what we have here and what it looks like, I want to point it out, just for pointing it out, a bear flag pattern. That's a pole, and that is a flag going up and going down. And what is it? Is it a bearish signal? It is a bearish signal. Is it gonna happen that it's gonna go all the way down? We don't know. What we know is a big move is gonna happen, and most likely it's gonna be a bearish move to the downside. I get this question a lot. Zach, what softwares do you use for your charting? And I can recommend two main charting softwares. The desktop platform that I use is TC2000. It is a flawless, it's an awesome software that I love. And for the web-based applications, I use TradingView. It's also an awesome platform. It comes with so many options. I use it for traveling sometimes, or using someone else's computer to go on the charts where I don't have my desktop application installed. Also, I use TradingView because lots of my students do, and I like to be familiar with it. And sometimes when we're on a one-on-one call, I can always use TradingView so they don't get confused, and we're both working on the same platform. If you're interested in any of those two platforms, I left both links in the description below. They're both affiliate links, so if you buy You might get a discount. At the same time, I would get a commission, a small commission that helps supports this channel without costing you anything extra. We went through a big portion of those patterns, but stay tuned for the next part. Make sure you subscribe for the next part, as I will explain the rest. And I will be telling you which is my best pattern and why is that. This video will be up here as soon as it is published. We'll see you next time.